Are we heading for a recession? The recession calls have definitely been growing, and this past week we've had a wave of economic data along with earnings reports to give us more insights about where things potentially may be heading, and of course some potential pitfalls as well as uncertainties that are yet to be resolved. Today we're going to dive into all of the data. We've seen inflation prints, the Federal Reserve just raised interest rates by 75 basis points, and we're going to dissect the fallout of that. You might have seen markets rising by 2, 3, 4% and wondering what happened there. Today we'll discuss that. But of course, earnings season has started flowing through. There's been some sectors that have outperformed and other areas that have really struggled. And all of these bellwether companies have also given us a bit of an understanding about where things may be tracking. And of course, we still have the milestone earnings up ahead, Apple, Amazon, and don't forget the US GDP numbers that will help us to define whether we're in a technical recession or not. Of course, however, it's much broader than that, and the definition of a recession does have a range of different factors to consider. It's a jam-packed episode, hope you enjoy this one.
Sit back and enjoy.
And so before we dive into all of the news, the Federal Reserve rate hike, and of course everything that's played out recently, let's have a look at the response. Federal Reserve raised interest rates by 75 basis points. It was about what was anticipated. We saw the S&P 500 up by 2.6% on the day. The Nasdaq, the more interest rate sensitive sector of the market, was up by 4%. Of course, we're still well off the highs that were set at the back end of last year. We can see here this has been a bounce off the bottoms, but we're still significantly down below. Of course, we're no longer in crash territory, but still well into bear market territory on the growth end of the market for the Nasdaq. S&P 500 out of the bear territory, but still in that correction territory now. And the question is, why did this happen? Particularly with a relatively hawkish discussion from the Federal Reserve, all things being equal. But as we can see here, having a look at this headline, this article from Bloomberg really helped to sum up a few different factors that must be considered when we're thinking about this rate hike as a totality. So Powell signals more Fed hikes coming, leaves out details this time. So essentially they stated, rather than, of course, forecasting and providing guidance about what they're anticipating, we're going to be data dependent. We'll take that approach to wait and see each time. We know that this rate hike for July has come through. There won't be one in August. The next one will now be in September. So there'll be 2 sets of inflation data and other sets of data to flow through before it. As we can see here, looking a little bit below the line, the Fed will continue to push on with the steepest tightening of monetary policy in a generation to curb surging inflation. We know we've got 40-year high inflation and 9.1% print for inflation was the most recent one we had over in the US side. Policymakers raising rates to that band there. And of course, just how much the future rate hikes will be will depend on how the economy performs. They've stepped away from specific guidance on the size of the hikes, though they haven't taken another jumbo move off the table. Well, having a look further here, well, another unusually large increase could be appropriate at the next meeting. That's a decision that would depend on the data and what the Fed's really waiting to see break or really waiting to see significant outcomes flow through into is the labour market. Unemployment still at record lows, and at the moment there's a relatively robust labour market. And so of course I think with the 3 handle in front of unemployment that there is room and a little bit of slack in that to continue to move higher, which could take some of that pressure off the wages level too. As we know, US GDP, there was a surprise shock to the downside, negative 1.6%, made up of mostly trade and inventory discussion on that front for Q1. We're about to get the Q2 numbers. The technical recession would be 2 quarters of contraction in GDP, but there is divergent opinions with the Bloomberg consensus at about 0.4%, so a weak gain for this upcoming quarter. Of course, interestingly, S&P 500 and the Nasdaq raise. Mostly the market was pricing in that it seemed to be a dovish tone, but when we're looking below the line and some of the other comments from analysts and economists as well, there was some unexpected discussions about actually what could it mean. And we know that the Fed put, it's no longer in place because of the high inflation in comparison to previous times and previous hike cycles. So a lot of investors are waiting to see when will the Fed pivot start to come through, but the Federal Reserve has continued to reaffirm they're going to do what it's necessary and what it takes to bring down that high inflation. Powell didn't flag a pivot to lower rates or even a pause, and Fed watchers have argued there's a disconnect between the central bankers said and how the market responded. The analysts have heard plenty of hawkish signals, including a refusal to even contemplate that we're in a recession with the strong job market gains, many references that restoring price stability is being prioritised over sidestepping a recession. Obviously that's the growth/inflation trade-off. The Federal Reserve and other central banks around the world still seem to be on that inflation side of the spectrum there, mostly focusing on that. Still haven't ruled out 100 or 75 bips rise in September. Central bankers trying to tame the highest inflation. As we can see here, 9 handle in front for headline inflation, CPI above that, in and around that 6% level as well. So it's still elevated levels, and they want to get that down and get that down quickly, because we know that inflation, it's essentially one of the most regressive taxes, as they often say, and it has significant implications throughout the economy, particularly for the lower income earners as well. The strategy does raise risks of overshooting. Obviously, the uncertainty about are we raising into weakness and what could happen as a result of that. We know that monetary policy operates with a lag. It's definitely not a precise tool at all. So, and that's actually been brought up in this area. Fed's tools are power tools. So bang, they're big tools, you get them out there, but you don't have precision throughout them. And obviously you've got to wait to see it flow through in the data in the upcoming months and potentially quarters. Moving on to another interesting article. This one here just had to do with the strong dollar. I'm not going to unpack it. If you are interested, good article called "The Strong Dollar's Wreaking Havoc Globally" on Bloomberg. But it's worth noting as well that obviously when we're talking about, say, the Federal Reserve or other central banks around the world, we're talking about it in a more localized context. Obviously markets and economies operate in a globalized context. And as a result of that, we've seen real strength in the USD. We've seen the USD achieve basic parity with the euro. And there are implications for the strong dollar on the commodities front, as well as for other nations around the world. We saw it with Sri Lanka too. So it's just worth noting that this is playing out in the backdrop. Having a look at some of the implications there. Driving up the cost of food imports, and this is coming as a result of the Federal Reserve's aggressive rate hiking. So driving up the cost of food imports, obviously there's implications for importers and exporters depending on the nation, and deepening poverty, fueling a debt default, toppling the government in Sri Lanka, and heaping losses on stock and bond investors and financial capitals everywhere. And just to get that context about how significant it's been, the greenback now stands at an all-time high, according to some gauges. It's up 15% against a basket of currencies since around mid-2021. The Fed's determined to keep driving rates up. We've just heard what Jerome Powell stated, even if it means sinking the US and global economies into a recession. So most people we know the previous statement was don't fight the Fed. Most people are now stating don't fight the dollar at this stage. So it's going to be very fascinating to see how this plays out, of course, too. Just having a look at this chart here, just to give us a bit of a context about how rapidly we've been moving through these rate hikes. As you can see, so this red line here is the discrepancy between the neutral gap, or the estimated long-run neutral rate, and the actual federal funds rate. As we know, we're at record low rates throughout 2020 and 2021, risen rapidly through the estimated long-run neutral rate. Before the Fed hikes cycle, around 2.5 to 3% was around consensus estimated long-run neutral rates, probably slightly higher now. But we can see here just how rapidly we've risen through, especially in comparison to the past periods. Obviously, as you can see here, these are dark grey lines. That's the recessions throughout these past 30 to 40 years. Having a look further, just having a look at the bond market is doing now. We all know about the 2-10 spread, and obviously the fact that we've seen an inversion of the yield curve. It's often been seen as a leading indicator of recessions. We saw an inversion earlier on this year. We've seen an inversion, and that's continued to go through that now, and quite significantly. And so we're starting to see that potentially a peak in the shorter term rates, while the market's pricing in a decline or a pivot or a transition in rate decisions later on from there. However, it's not only in the macroeconomic picture. We know we're into earnings season. If you have a look at what's up ahead in this next day, it is absolutely stacked. Just the names here, when you look at Hertz, when you look at Merck, MasterCard, Pfizer, all of these companies, Honeywell, significant ones for the macroeconomic picture. But then on Friday is when it gets really, really interesting. We've got Apple, we've got Amazon. We've already had insights from some of the mega cap technology names earlier on this week, and they're giving us that understanding about where things potentially could head. So trying to answer that question about, are we in the recession? Of course, nobody knows. We know the technical definition of it is 2 contracting quarters successively. We had the negative 1.6% quarter in the first quarter. We're just about to get second quarter GDP figures. Divergent opinions. Some people are anticipating an increase. Goldman Sachs, for example, while Moody's Analytics sees a 1% decline. It'll be 8:30 a.m. US time on Thursday. Sluggish growth forecasts follow that 1.6% decline. That was a shock, mostly on trade and inventory. But even if we do see the second negative quarter in a row, even if that does happen, doesn't necessarily mean that we are in a recession. It will be defined as a technical recession. But the commonly accepted definition of a recession in the US is the National Bureau of Economic Research are the ones who officially call it, or as you can see here, the official arbiter of recession calls. So everyone will be watching these GDP numbers. It's going to be hotly anticipated. I'd love to know your thoughts, so drop in a comment below. We've just dropped this second channel for investors, so subscribe and turn your bell notifications on. We'll keep you updated with everything happening on in the markets. A big thank you for joining us. It's a fascinating time on markets. For now, stay well and happy investing.